Then we go to a second part of this project, a second report that also came out on Monday, which is around navigating the nuances of net zero targets. Net zero is another very popular target type that cities, regions, and businesses are putting forward. And then we have two guests that are not part of the project, but are very relevant in this discussion. And first we will have Jessica Andrews from UNEP-FI, who is, UNEP-FI is organizing a Net Zero Asset Owner Alliance, an important initiative by investors, and she'll tell us her view on key challenges around setting such targets. And then we have Emily Krebs from CDP, which will provide their view. CDP is a very important player in this whole system of reporting targets, analyzing targets, and moving things forward. So that's the plan for today. If we move to the next slide, then you can see this overview. The project that I was mentioning has 4 outputs this year, and we are talking about the 2. So the first one is the financial sector commitments, which Katharina will talk about, and Mark, and then the net zero targets, which will come after that. There are still 2 more reports coming out in spring 2021, and that is aggregating as many non-state actor activities as we can. So cities, businesses, regions, hopefully then also the financial sector commitments, and putting it all together in global perspective to see whether that all adds up. And we will also include some progress assessment, whether the targets that these players have put forward are really being implemented or not. It's always good to make targets, but it's even more important to then meet them as well. So without further ado, if we go to the next slide, still a reminder that you have this question and answer button. So use it and write your questions if you want. Then I hand the word to Katharina Lütker-Müller and Mark Rolsma. Both are part of the project that I was describing, and they will lead us through this new report, Unpacking the Finance Sector Climate-Related Investment Commitments. Katharina and Mark.
Yeah, thank you, Nicholas, for the introduction, and hello, everyone. So in the next few minutes, Mark and I will walk you through some of the high-level findings of our new report about the finance climate-related investment targets. So in second, in terms of content, we first provide you with some insights on the landscape of climate-related investment targets, and then move on to cover the impacts and relationship of those targets on global greenhouse gas emissions. So in terms of background, the role of finance was specifically recognized by the Paris Agreement, which calls for finance flows to be made consistent with the pathways towards low greenhouse gas emissions and climate resilient development. Since then, the number of climate-related investment targets by financial institutions has increased quite dramatically. In this report, we take stock of those targets and provide insights into their relationship with greenhouse gas emissions. Just a few words on terminology. So what do we mean by climate-related investment targets? There we mean all those commitments that directly or indirectly target the emissions deriving from an investment portfolio of a financial institution. And as financial institutions can be invested in a number of different asset classes, and their targets may refer to one or all of their investments, we also consider a number of different asset classes, which you can see on the slide. Now I hand over to Mark to give you an overview of some of our findings from the landscape analysis.
Yes, thank you, Katharina. Yeah, so we first started off to define or look at the landscape of climate-related investment targets. For this, we used the Global Climate Action Platform, formerly known as the NASCA platform, that is hosted by the UNFCCC. They They collect commitments on global climate action by different non-state actors, such as companies and cities, but also investors. And we also looked at the CDP dataset from last year. CDP is a not-for-profit organization that has an environmental disclosure system. And also companies disclose emission reduction targets and emissions annually to CDP. So more than 1,000 of these financial institutions have made commitments on GCAP, or at least reported to GCAP. And 350 financial institutions disclosed some type of climate information to CDP last year. We distinguish between commitments that are made by individual financial institutions and those that are part of international corporate initiatives. If you look at the GCAPs, or the platform, then you see that there's around 450 financial institutions that have disclosed climate commitments or climate-related investment targets, and they add up to roughly more than 1,000. Looking into the CDP data set, we find 250 financial institutions that have committed some kind of emission reduction targets. They add up to around 1,600. However, most of them are related to own emissions or electricity use, and not to the carbon footprint of their asset portfolio. There is only 3 financial institutions that have up till now, or at least we could find in this data set, that have committed to investment-related climate investment targets. International corporate initiatives, they bring together different types of actors to mutually act on climate change. We have identified 7 large initiatives that also include financial institutions, and I'll show 3 of them here on this slide. One of the largest is Climate Action 100+. It includes 500 investors that in total have roughly 47 trillion assets under management. These more than 500 investors engage with 160 of the largest emitting companies around the world. Then second, there's the Divest Invest initiative. There are a lot of different types of institutions that are part of this initiative, but 220 of them are financial institutions, and the total assets under management is 40.1 trillion. So the members of this initiative, they aim to divest from fossil fuels. And then finally, you have the Net Zero Asset Owner Alliance. This is a framework or initiative with investors that say that they will align their asset portfolios with a target that will reduce greenhouse gas emissions to 0 by 2050. And this framework also has a target setting framework, how these portfolios can be aligned with this target. Next slide, please. So what's the geographical spread of these initiatives? So for those initiatives which we could find data of, we conclude that most of these commitments are done, or at least the headquarters of these financial institutions are in North America, Europe, and Oceania. We've also looked at the type of target that were committed by these financial institutions. If you look at the individual commitments on GCAP, you see that 45% of them are related to emission reductions. But as I already said, most of them to own emissions and not their asset carbon footprints. 40% of these targets are related to green bonds and 30% to an internal carbon price. If we look at the Climate Action 100+ initiative, we find from the 160 engaged companies that 160 companies that they engage with, 91 have already published both greenhouse gas inventories and targets to CDP. And based on these 91 companies, we estimate that they could reduce 0.3 gigaton of reductions by 2030 relative to a current policy scenario. However, for this, we did not include the recent announcement that 50 of these companies will aim for net zero emissions by 2050 or sooner. And then finally, there's the Divest Invest initiative. 144 of the financial initiatives in this initiative aim to fully divest from fossil fuels. 54 will divest from coal, and 25 have other criteria for their divestment targets. So the conclusion of at least this landscape analysis is that we see that the membership of this initiative is growing very quickly. However, data availability is still very limited, especially for individual targets. So we were not able yet to calculate the emission reductions or the ambition of these targets. This is already by itself a very difficult concept. Katrina will tell you everything about it, but data is also not available. At least what we found is that from these three large initiatives, at least then 47 trillion assets under management is already committed to some form of climate-related investment targets, which is already 25% of the global financial market. So over to you, Katrina. Thanks.
Yeah, thank you, Mark. So yeah, as Mark already mentioned, the impact of climate-related investments on greenhouse gas emissions is something that is very difficult to do. So in fact, the divestment positive impact and engagement targets that we looked at might well help minimize the investment risk and decrease the carbon intensity of a portfolio. But the impact on real economy emissions remains uncertain because of the indirect control that the investors have on their investees' emissions. So reducing the carbon intensity of a portfolio by divesting, for example, with the objective of aligning the portfolio with the Paris Agreement, does not necessarily always lead to emission reductions in the real economy, as others can invest in the emission-intensive assets that were sold by the investor. That being said, we also looked at a few factors that may increase the likelihood that the targets may actually lead to emission reductions. And we identified a few factors on different levels, which you can see on the slide. So just to give a few examples, at the financial institutions level, the potential impact on emissions is higher if a critical mass of financial institutions come together. Relatedly, the higher the market share of the financial institutions that are involved and the higher the monetary value of their investment, the likelier it is also that the financial institutions can then effectively influence company behavior. Also, it is generally more likely to observe impact if the targeted company has previous experience with ESG issues. And relatedly, impact can more easily be achieved if the investment targets or the targets an investment in a country where the awareness for climate change is already quite high. Yeah, then we also looked at the cause-effect chains of the three key targets that we considered in this report. So divestment, corporate engagement, and positive impact investing, and how those targets can actually translate or affect greenhouse gas emissions. So we see that the cause-effect chains differ per type of investment target. Taking just the example of divestment here, so divestment may lead to higher cost of capital or also higher cost of insurance, but then may also lead to stigmatization, and the stigmatization may then lead to divestment by other shareholders, or it might increase the pressure on the targeted company, and so consumers might turn away. On the side of the investee company, this might then cause the company to move away from its polluting activities, or the company might also set targets and work to implement those. So when the investor's target causes this type of impact, it may effectively alter the investee's company and lastly have an impact on real economy emissions. Then we also looked at the likelihood of achieving impact by type of target and per asset class. And we see that here are differences, not only depending on the type of the target, so basically the cause-effect chain that I just talked about, but also the asset class. So in this figure on the slide, you see that for the asset classes we looked at, we find that engagement might be the most promising strategy to follow if an investor is looking to have impact. But we also find that impact is more likely to materialize for some asset classes compared to others. And here, for example, targets that relate to loans and private equity in particular are found to be relatively more effective than for other asset classes. And we think this is important because targets can potentially be more effective if they consider the characteristics of the underlying asset classes. I skipped that. So concluding, we see that the growth of climate-related investment targets is quite remarkable. 25% of the global financial market measured by the assets under management has set some type of target. This is promising, even if the ambition of those targets may vary quite a lot. Corporate engagement is found to be the most promising target, followed by divestment and positive impact investing. We also see that the action is concentrated so far in the West, so there's large untapped potential in other parts of the world. And then to help financial institutions set more and potentially better targets and also help them follow through on those, we need the finance and scientific community to further advance methodologies for Paris-aligned investing, especially at the sector and asset class level. And finally, more and better data is also needed to make a better and full assessment of the financial sector's climate-related investment targets on real economy emissions. And with that, yeah, I would hand back over to Niklas, and you have the link to the report on the slide as well.
Thanks a lot, Katharina and Mark, for the introduction to this report. And we already have a first question on whether and why there's so much concentration on Australia, but that's for later. That will be answered later. Keep on typing questions in the question and answer box. But first, we will go to the next presentation, which is from Thomas Day, my colleague from New Climate, and he will lead us through the nuances of net zero targets. It's a bit going away from the finance. It's broader than finance commitments, also touching it. After Tom, we will go back focusing on the finance commitments. But anyway, over to you, Tom.
Many thanks, Nicholas. Yes, as Nicholas said, we've been working together at New Climate with our colleagues at Data Driven Envirolab to look at the momentum for net zero targets. Katharina mentioned that target setting is really picking up momentum across the finance sector, with 25% of institutions surveyed covered by some sort of target. Net zero targets, as you see here in the picture, have really picked up momentum in the last 2 years only, since the concept was very heavily discussed in the IPCC special report on 1.5 scenarios, in which we saw very clearly the need to move towards net zero. And in that context, net zero is referred to as achieving a balance between emissions and removals. What we actually see from net zero targets and what we are discussing here and analyzing in our paper doesn't necessarily restrict to this this clear definition, but we actually see that that actors, companies, cities, regions, they have quite a range of definitions for how they consider what they consider net zero to mean, and that includes something which is more aligned with the IPCC's understanding, but also ranges to other understandings, such as achieving a balance between emissions and reductions, such as offsetting. So we see here that in general, the interest, this is the picture shows Google searches for the last 2 years, according to Google's index rating. And so this is an impression of the general public's interest in net zero targets. And one takeaway is that it's increasing and that it was relatively non-existent a couple of years ago. Another takeaway is that this is really driven by some of these large events and summits. So for example, the Global Climate Action Summit, the COPs, we see each time that this causes quite a peak in public interest and pushes interest further up over time. So this interest from the public, we see it matched, of course, by the non-state actors, by the target setters. So the target setters we've been looking at in this report are cities, regions, and companies. And the map you can see here shows the coverage of subnational, so cities and regions, of net zero targets from these actors. The map is getting quite colorful, and actually by now, so in 2020, these net zero targets from cities and regions cover already about 11% of the global population, or I should say at least 11% of the global population. And it's really quite variable between regions. Some countries have a very extensive coverage. For example, in Australia, approximately 95% of the population are covered by such targets, despite there being no net zero target at the national level. Also in South Africa, Spain, Sweden, Japan, and Canada, there's a very high proportion of the population being covered. North America overall, approximately 2/3 of the population is covered. So this is approximately a doubling of the year before, and shows that the interest from the general public that you saw on the previous slide is really being matched by the subnational target setters. Looking at the corporate data, looking at data from 2018, so that's the 2019 survey information from CDP, we see that over 1,500 companies are also setting net zero targets, and these companies account for 11.4 trillion. Moving back to the finance sector focus, this is one of the more prominent sectors covered here. So approximately 10% of the revenue and the companies here account to the finance sector. So the finance sector is one of the most active sectors, and I showed already that in 2018, we estimate that net zero targets from these companies accounts for approximately 2 trillion worth of turnover. We know already that by 2020 this has increased to at least 5 trillion. For 2020, it's not yet possible to do a systematic assessment, but we know from anecdotal cases that this is increasing very quickly. So we see that accelerating trend does continue. However, although net zero targets sounds on paper quite unambiguous, we actually see that the meaning between these different targets varies quite considerably. So the majority of the targets we're looking at are considering the emissions that are only coming from the direct operations of those financed institutions. Downstream emissions and also upstream emissions, so scope 3 emissions, that includes suppliers, but also emissions that are coming from investments. These are very rarely considered, and this is a very important topic for the finance sector in particular, since scope 1 and 2 emissions, so that's the emissions from one's own operations, these account on average for only about 3% of the emissions that these companies are reporting. And it should also be mentioned that the companies aren't always reporting the full extent of emissions from investments. So that 3% is probably quite an overestimation as well. So that means that if you look over to the right-hand side, the graph here is showing what different scope of coverage are these institutions including in their net zero targets. And this is from the data in 2018 that was reported in 2019. If you compare to the top bar, which shows all of the financial institutions that we have surveyed, the second bar shows that less than 50% of these companies actually include scope 3 emissions. So already the majority of companies are only including a maximum of 3% of their reported emissions in their net zero targets. If we go another one further down, then this shows the companies that include downstream scope 3 emissions, including emissions from leased assets, for example. This is even less. It's altogether around 15% of all of the companies setting net zero targets. And companies that are including the impacts of investments, this is even smaller. Mark mentioned that from the survey, there were only 3 companies setting targets that have mentioned this. Of the companies that commit to net zero targets. There's only one or potentially two companies here in 2018. We know already that by 2020, this has increased quite significantly due to different initiatives and alliances that are driving this impact. But in general, a lot of companies are discussing that there's a lack of methodologies for being able to do this. And it's not so clear. It's quite clear that companies need to move forwards a little bit in this way, and also being a bit more transparent about what is included within these net zero targets, since there's quite a range of what's included here. This is one area where there is an ambiguity in net zero targets. What we also look at in our paper is how there are other issues that lead to net zero targets not always being easily comparable. So the scope is the first thing, which I just discussed. One issue is also about the robustness of targets set, and across all of the non-state actors, so that's also beyond the finance sector, but also other corporates and subnational actors. We see that only approximately 40% of these actors have clear action plans for how they want to implement their targets, and even fewer of them have implemented concrete policies. I think this is quite an important aspect when one considers the mixed success rate for the implementation of targets that such actors have set in the past. And where we see that having a clear plan and having a strong stakeholder process for building that plan, for sharing ownership of the target which is set, really helps to ensure that target is implemented and is not only a nice communications tool. Another area where these targets differ widely is with regards to their approaches for energy procurement. So that's their scope 2 emissions. And there are approaches here ranging widely from the purchase of renewable energy certificates to the establishment of power purchase agreements and even installing on-site generation. And depending on the nuances of these, it can mean everything from there being zero impact for emission reductions to there being a complete reduction of emission reductions from energy procurement. This is not captured from the face value of a net zero target. And another final area here where there's an important nuance is also on the reliance of offset credits. And as I said at the very beginning, there are some companies and institutions that very clearly state that they don't consider emission reductions elsewhere to be part of net zero, but rather they only consider a balance between emissions and removals. There are others that rely very heavily on offset credits, and some even that rely exclusively on offset credits and simply offset their entirety of emissions. Historically, this has been somewhat accepted, although there's been broad agreements that there are difficulties here with offsetting and that there are pros and cons. I think one of the key issues now is that when we look at the volume of offset potential that's there, we see from recent analysis that only approximately 4% of the potential offset credit supply is really linked to mitigation activities that depend on those revenues to continue their operations. So that means it's very difficult to select offset credits that really have an impact. Since the onset of the Paris Agreement, there's even more complicated issues affecting offset credits and their additionality. These are things that are more closely analyzed within our report, but it altogether gets the picture that net zero targets on their face value are not always offering the level of transparency or constructive detail that would be needed to assess whether or not this is an ambitious target from the actor and what it really includes. So net zero targets could be, but they're not always necessarily the most ambitious approach that a company or a financial institution could take. And some companies are moving away from that actually and begin to pursue more of a constructive transparency rather than a carbon neutrality claim to say, for example, that they cannot see at the moment how they could be carbon neutral since they are not in a carbon neutral world and it's difficult to abate some areas, and to rather seek solutions for that rather than to claim a carbon neutrality which could in some cases distract attention. Something that some investors are thinking about doing rather than claiming carbon neutrality of their investments, for example, is to commit to adopting criteria to align investments with Paris Agreement objectives. And that's obviously a very closely related concept, but instead it means, instead of committing to reaching complete decarbonisation of your portfolio by a certain date, if you're not necessarily sure how that can be achieved, and in the cases where that might then affect the meaningfulness of that target, it could also be possible to instead be very transparent about the criteria that is being used to align investments with the Paris Agreement and to show what efforts are being made to go in that direction. And there's an increasing amount of literature from the scientific community on what criteria could financial institutions use for this, which could then be picked up. So the key messages are that momentum is increasing, it's accelerating, and that's very encouraging, particularly because this is really driven by public awareness, public interest. And I think that's very encouraging because it shows that that increasing public awareness and interest can really drive action from the corporate sector and from the finance sector especially. This impact has been seen I talked mostly about the finance sector, but we see that it's really consumer-facing sectors that are most strongly affected by this, and where the interest is in net zero target setting is really accelerating the most. So this shows the link to the consumer base is very strong. However, the real implications of these targets do vary significantly depending on the small print, which cannot usually be seen. And so constructive transparency from the actors should also be considered a key indicator of ambition. It's not only a question of by when do they commit to go to zero, but how much do they tell you what they really mean by that target and what's in the details. And what's going to be coming from us in the next 1 or 2 months is a more detailed guidance on how to navigate these nuances in net zero targets, how to understand what's really ambitious, and how to understand how you can set an ambitious target. This will come later in 2020. The report, which is already available on our website as of yesterday, is a pre-release summary document which shows the momentum and gives a first taste of these issues. So I would recommend you keep an eye out for the full assessment later on.
Thank you, Tom, for this overview. And we've now seen from Tom here the rising momentum on net zero targets. We've seen the same thing from Katharina and Mark, that more and more financial institutions are taking on investment-related commitments. So a lot of momentum, but I think both also said we can't analyze everything. Devil is in the detail a little bit. We need a little bit more transparency on what's really happening. And that's why I'm very happy that we have with us Jessica Andrews from UNEP FI as one of the practitioners, so to say. UNEP FI is organizing the Net Zero Asset Owner Alliance. So one of the initiatives that Mark and Katharina mentioned that try to get the members of the initiative towards decarbonization of their investment portfolio. And Jessica, I would like to hand over to you. I hope you're ready and I can see you now, and please go ahead.
Thank you,
Great that you're here.
Thank you. And thank you, Katharina and Mark, for having me. Congratulations on your report. So I'm very excited to be here with you today. As mentioned, my name is Jessica. I work with the UNEP Finance Initiative as a senior program manager for the Net Zero Asset Alliance. And I focus primarily on our target setting framework and our monitoring and reporting of that. The Alliance just launched 1 year ago this month. So we're really in the full scale up mode, but it is very exciting times, and all of this research is tremendously valuable to us and our colleagues. So if I could go to the next slide, please. So just in the last 2 years, as you saw, my role at UNEP FI has expanded to cover not only Alliance, but also UNEP CCC Race to Zero, the Investor Agenda, Investor Climate Action Plans, Science-Based Targets for Financial Institutions, and Business Ambition 1.5 Pledge. So there's quite a lot of actors calling on these investors to make these commitments and be transparent about them. And I think we can see that bearing out in the landscape. If you could go to the next slide, please. Thank you. So I was kindly invited to talk about the key challenges for targets and what that means for emissions. And I identified 4 of the items that we're dealing with within the Alliance, but also that any financial institution would need to deal with in setting a temperature alignment or Paris Agreement aligned target. If you go to the next slide. Thank you. So what exactly is the target? So we have 29 asset owners with nearly 5 trillion in assets under management committed to net zero by 2050. But as you heard from previous speakers, this can be challenging to define, track, monitor, and report on. They've committed to net zero GHG by 2050, so that's an important first point, and to intermediate targets every 5 years in line with what governments are reporting on. The last thing that's really important to note from their commitment here is that they've committed to working through their ownership in companies to transition the underlying business models of the companies they own, rather than through a divestment approach in the first instance. Go to the next slide. Thank you. So the first challenge for any institution in identifying what they want to commit to is identifying what exactly is the target. So we know from the IPCC work that net zero gives us a fair chance of reaching a 1.5 degree target. And that's something the Net Zero Asset Owner Alliance has indicated, that we want to be net zero emissions, the thing we can track and measure and influence, for the 1.5 degree outcome, which is a little bit more challenging to directly track and influence. And what you see there is that it means that there's a carbon budget left that we have to stay within. But how you get there can vary quite substantially, and the assumptions you make around what net zero in 2050 means have broad implications for the intermediate targets you would set in the interim. If you go to the next slide, you can see how the IPCC classifies this. And of course, this is probably not new to many of you on the line, but we have no overshoot pathways, limited overshoot, and higher overshoot. So this is the idea that you can carry on closer to business as usual should you have negative emission technologies that really scale up in later decades. And the idea that you can even overshoot a 1.5 degree target and come back down. And so the Alliance and others have said that what we want to do is err on the side of caution and focus on no or limited overshoot pathways. And that means when we set our intermediate targets, they need to be steeper in the first instance, and therefore really keep in line with global emissions reductions that are more straight lined to net zero by 2050. And they're the steeper blue curves that you can see there. And the next slide, you can kind of see then how that starts to play out. So this is just a broad indication, but essentially what you have is a global emissions trajectory, so following the curve for the global economy, but you could have a portfolio that isn't necessarily reflective of a 1.5 degree temperature outcome, but is still net zero by 2050. And that's because investors have the wide range of economic sectors to invest in, and they could choose to prioritize those that have lower emissions. Thus, their portfolio is net zero, but their overall impact toward the 1.5 degree may not mirror what's necessary for a 1.5 degree world. So what we've really looked at and what others have looked at is sectoral decarbonization pathways, understanding what each sector needs to do in order to enable a net zero economy or 1.5 degree outcome. And that means you really have to have very detailed and concrete knowledge sector by sector on negative technologies, on energy supply and demand, but really, just general adjustments to business models. And the investors need to know that in order to be able to plan their own targets and their investment strategies. The next slide, please. So this is just one example of the additional challenge, so data. CDP does a tremendous job of collecting data. There are many providers out there, and what we really need to do then is take that global carbon budget and compare it to what we're seeing from companies in these various sectors. This is one example from TPI, which is the Transition Pathways Initiative. It's a great initiative that tries to track where corporations are against the trajectory they need to be on for one of the temperature outcomes below. And as you can see, 1.5 actually isn't even there because this is, very new and growing field, and it's quite ambitious. And for us, the important part is knowing the delta between where corporations are today and what they need to do in order to achieve 1.5. You could go to the next slide, please. So once you have an understanding of where you want to be in the global economy and contributing to global goals, and you have data underlying holdings, you need to understand how that relates to your portfolio. So that's when the methodologies become very important. SBTi has done really good work on this for several years, first with corporates and then with financial institutions. IAGCC is a Paris-aligned investing initiative, so there's quite a lot of work going on to support investors to set methodologies. And of course, the Alliance is working very hard to do the same. And a quick review of sort of the existing landscape out there when it comes to targets is looking at SBT and the 3 approaches that they've put forward for corporates. We've adjusted and adapted that for Alliance members and are working on our guidance for our own members. But there's 3 approaches here: sector decarbonization, SBT coverage, and convergence. And basically, the sector decarbonization approach looks at the emissions efficiencies that each sector needs to make. An SBT coverage approach would say, I want all of those that I hold in my portfolio to be to have their own target and thus contribute to my target. And then the convergence approach, which was really designed for corporates, but abstractly we can think about how it has applicability for financial institutions, is you take the budget for that sector, and for corporate for financial institutions that would be the full scope of all sectors, and put that over a metric so that whether or not you've already decarbonized heavily or you need to do so, you can converge upon a trajectory that will get us all there. So there's a range of approaches out there. Some work better than others because of the way that they can be translated to portfolios or tracked because of the underlying data availability. Scope 3 is also a large challenge. So the Alliance's commitment is on its own portfolio emissions, so it's Scope 3. But it is challenging to go down to then the corporate Scope 3 based on their own reporting. And then, of course, you have a range of asset classes. And we saw earlier in the presentation that financial institutions have influence to greater or less degrees, depending on the type of asset class it is. Sovereign bonds, for example, are much more challenging to both attribute emissions for and to engage with than, for example, a listed equity. So we see, a broad range of methodological issues, but a lot of progress in this field too. The final message I want to leave you with on the last slide there is the final challenge that we see is there's a lot of inertia in the world. So Newton's first law, the IPCC identified in 2017 that we probably hit 1 degree of temperature warming that was human induced, and we are on track for much more than that. And so it really means that we need to take and bend that curve the other direction, and there's a lot of momentum going in the existing direction. So it's really important to make sure that everyone has a role to play in this, not only financial institutions, but corporates and policymakers and even citizens. So with that, thank you very much for having me, and back over to you, Nicholas.
Yeah, thanks a lot, Jessica, for these insights. And you're right. I mean, inertia is happening, and but we don't have much time actually to get the curve, and we need to work over that inertia. But as we've seen, there's a lot happening, and I would look forward to your final method once it's there, so that it can help the financial institutions to do the right thing. I still one housekeeping thing. Thanks for sending in a lot of questions. If you see that your question disappears, that doesn't mean that it's gone. It only means that it is sorted somewhere, and that we will come back to it. Yeah? So don't worry if your question disappears in the question and answer box. And please continue to put them in there, because we're now coming to the last of the round of presentations, which is from Emily Krebs, already here. Thanks for being here. She's a Global Director, Capital Markets at CDP. And CDP is one of the project partners here in this project. And without CDP, we couldn't do the work because we wouldn't have the data. So it's a fundamental role that CDP is playing here. And well, you're also analyzing your data that you get. And I hope, or we all hope, to hear a bit from you about that. So over to you, Emily.
Great. Thank you so much, Nicholas. And we're delighted to contribute to the data to this report. You know, I'd begin by echoing a number of sentiments from both Thomas and Jessica. You know, that we do like to work in partnership and collaboration, and there is a lot of work still to be done. And we're delighted to be able to show where the world sits today and where the pathway can be forward. So just going to the first slide, I wanted to give everyone an overview of how we work and how we collect this data. CDP is, as has been mentioned, a global nonprofit. We've been around for about 20 years, and our initial theory of change was to get investors as the requesting authority. So we have 560 of the world's largest institutional investors who give CDP the authority to request from companies around information around climate change, water security, and deforestation. We've aligned our questionnaire with the Task Force on Climate-Related Financial Disclosure, but we also ask many other questions related to the target setting. And as the different methodologies evolve, as the science continues to evolve, we again look to evolve the questionnaire such that we're ensuring that we're asking companies and issuers the right questions. We collect this data through our online reporting system, which results in a uniform, comparable set of information. And then we provide that information back to investors, but also importantly, we provide it to the academic community, the civil society community, and others, which is really how our data has contributed to this report. Moving on to the next slide, just to get a little more granular in terms of the questions we ask and how we devise them. As I mentioned, we have three areas: climate change, which is our oldest questionnaire that focuses a lot on the emissions, the target setting. This is where we get a lot of the information that goes into the setting of net zero targets or science-based targets, as Jess mentioned, for the Science-Based Targets Initiative. Our deforestation questionnaire is focused on forest risk commodities, particularly cattle, soy, timber, palm oil, and rubber. And then water security is really focused on the overabundance or scarcity of water, the withdrawal of water, and increasingly on water pollution. We overlay these three themes with a sector-specific focus. Starting in 2018, we have developed sector-specific questions for starting with the high emitting sectors, 18 different sectors. And so essentially we have created a matrix of different types of information that we can request based on the type of company and their operations. And then finally, one of the critical steps that we took in 2018 was to align with the TCFD, the Task Force on Climate-Related Financial Disclosure. And we'd already been asking a number of questions that were captured by the framework that was announced. And we went through a rigorous process and added a climate-related scenario analysis. And that really aligns with the TCFD framework, such that a company that's disclosing to CDP and answering some of these specific questions really has the fundamentals of their TCFD report there. So this is just an overview of kind of how we work and the data we collect. And I want to go into demonstrating kind of how this data can be used in addition to supporting reports like this one. So moving on to the next slide. In the report, it talked about the Climate Action 100 Plus initiative, the CA 100 Plus. You know, for full disclosure, CDP is not one of the steering committee partners there. We did help to design the initial list of 161 companies. And as we've watched the engagement process by the investors and the steering committee members there, we wanted to look at our data and say, you know, what conclusions can we draw from this as we see this investor engagement going on in parallel. So here are our three key findings from that perspective, and I think they support a lot of the points that Katerina was speaking about earlier. First of all, that we do see an increase in TCFD-aligned disclosure, but there are still clearly gaps in that perspective. As the new Climate Institute report highlights, that there are a number of environmental risks that these companies have identified, but investors, we encourage them to pay more attention to some of the blind spots of corporate disclosure. And this is really where that corporate engagement component of the new Climate Institute report is amplified. And Jess mentioned this with the Net Zero Asset Owners Alliance as well. You know, we at CDP think that corporate engagement really is an important way forward, particularly as we navigate all of these different standards and frameworks. And then finally, we do think that senior oversight is needed within companies, and that needs to be backed up by tangible incentives. So one of the things that CDP asks of companies, and we encourage investors and financial institutions to pay attention to, is what type of management incentives or board incentives are built into a company's process to ensure that the company really is taking some of these environmental targets seriously. So moving on to the next slide. And then in terms of companies responding around the targets, we do have a number of them with the well below 1.5 degree targets, but we still think that there's a significant amount of work to be done. And as Thomas highlighted, you know, net zero targets may not necessarily be the most ambitious. And so we continue to challenge companies to be very explicit on the types of targets they're setting and the level of ambition that is aligned with them. And finally, that the companies, the 160 companies, do report that a lot of these issues are being integrated into their business strategy. But again, we need to see greater transparency about the details of those strategies and the ultimate transition plan. So I think that really echoes some of the points that both Thomas and Katerina talked about. So moving on to the next slide. So just in terms of looking at the companies within the 160 within the 160 in the CA100 plus universe, this just is an overview of which companies had submitted where. And what was interesting is, you know, obviously we saw a significant number of the companies submitting to our climate change questionnaire, which goes to the heart of this discussion in terms of looking at net zero targets. And it's certainly where we've seen investors and the financial community engage in companies most readily. We see a significant opportunity for companies and for investors to talk more about water security and how water security factors into thinking about overall environmental performance and ultimately into a more sustainable operating framework. And then on the forest side, we think that there is that the questions we ask around deforestation and forest risk commodities are inextricably linked for companies to be able to achieve some of their net zero targets. If we think globally, 35% of emissions come from deforestation, and so without addressing that component, we think that it's very unlikely that we'll be able to meet some of the ambitious goals of the Paris Agreement. So we'd encourage, again, on that corporate engagement front, for investors and the financial institutions really to consider how some of those deforestation-related operations can be addressed. And on to the final slide. So this is just looking at the CA100 plus companies and the GHG emissions that were reported by that. You know, one of the things that we were impressed by was really the scope 3 component, and we do think that there is still a significant amount of work to be done because we had to estimate on those scope 3. As you can see, those were cleaned, applicable, estimated emissions that CDP came up with. So I'll pause there. You know, I think in conclusion, I just want to say that CDP has been running our disclosure process for 20 years. And this year we've just completed our 20th cycle where our official numbers aren't in, but we anticipate having collected information from over 10,000 corporates and issuers globally. It's really critical that we continue to see corporate engagement at every aspect of the financial services world, because the real economy provides this information for the financial institutions to be able to use that so that they can account for their emissions and start setting their own targets. So there are a number of different accounting standards like PCAF, the Partnership for Carbon Accounting of Financials, and others that are increasingly calling for financial institutions to apply real economy data. But that real economy data in a lot of instances has been generated from CDP. So we appreciate all of the collaborative corporate engagement efforts that are going on across the space. So thank you very much for having me, and happy to take any questions.
Yeah, thanks, Emily. Thanks for this. And that actually concludes the rounds of presentations. And now we have another 30 minutes available for questions from you. So please continue to use the question and answer box to ask your questions. We have already collected a few, and I will ask the speakers, all speakers actually, to turn on their cameras and mics so that we are flexible in moving to the questions. I think the way I would like to do it so far, we have a few clarifying questions on the broader term of net zero targets. I would like to take them first. Then there's a few questions around the finance sector more in particular. We probably can take them later. And then let's see how far we go. I also want to, at the very end, to give each of the speakers the opportunity to say some last words, and with that we should be well set for the next 30 minutes of the questions. All right, so thank you for the questions. Let's start then with some clarifying questions on net zero targets, so more in your direction, Tom. There was one question from Michelle Den Elsen on the question of offsets. Do we know how much emissions will be reduced from these net zero targets if you take out the offsets? That's the first question. And while we're at it, there's a second question. And there, JC Seegers, he read the report very carefully and looked at the definition, what a net zero target is and what we count for it. So maybe, Tom, you can answer these two questions.
Sure, thank you, Nicholas. To the first question on how many or what share of cities and companies have net zero targets, or sorry, have offsets in their net zero targets. I can't give you a number, but it's something we're currently analyzing, and we're hoping to put in the report that comes in 1 or 2 months. What I can say from looking at the data already is that it is something that's applicable for both subnational and corporate actors, so cities and companies, perhaps less so for cities and regions than for companies. I think one reason for this could be that companies are historically very familiar with carbon market approaches through compliance schemes that have existed in several countries already. Also, another reason could be that that cities and other subnational governments are used to a different level of transparency and accountability than the corporate sector traditionally is. So this could be a reason for a divergence in approaches there. But I would hope to be able to put more concrete numbers on it when we're through with our full analysis. Regarding the terminology of that we included in our report for net zero, the specific question was related, I think, to why we included companies that set a target for 80% or more, and whether or not this holds companies and cities back from going all the way. So this is a methodological question primarily, where for our report we didn't define and make an assessment on whether we consider each of these targets to actually be net zero according to our understanding of net zero, but rather we wanted to build up a landscape of what do others call net zero and what does this really mean. So this included everything that was net zero, but also targets that were described in similar words to be deep decarbonisation, or even go into 80% or more. And 80% or more, we decided to pick up because given all of the different given the different range of meanings that comes under net zero, we didn't see such a big difference necessarily between a target that was actually 80% emission reductions and a target that was net zero, where it's not clear if there are any emission reductions. So for the purpose of having a scope that we could analyze, we included all of these targets, and whether or not that holds cities and corporates back to go 80% of the way, I don't think so. I would look at those targets sometimes quite as quite credible credible indications of ambition, in the sense that they've explicitly decided to say they'll reduce emissions by 80% instead of saying that they will seek to be net zero, without giving the details of how they will do that. It doesn't always mean it may be ambitious, but it certainly can't be taken on face value that it's less ambitious than a net zero target.
Yeah, thanks, Tom. So it's another indication that when things are very dynamic, then there's it's not always very clear what individual terms mean. And well, I hope that with the work and the more work we do in this area, it becomes clearer and people use the same words to describe the same things. Thanks for that. And then I think there were a few clarifying questions on the finance sector presentation on the very first one on the report, and one that struck several, or well, in this case, Sander Chan was asking whether there is, why there is so much commitment shown in this one slide in Australia, and why there is not so many commitments shown from the financial sector in the developing world, and whether that is real or whether that is just a data artifact. Katharina or Mark, would you like to comment on this one?
I can at least comment on Australia one, and maybe Katrina can add to that. So first, a general remark is that this picture is only based on Divest Invest and the Net Zero Asset Owner Alliance, as those reported the countries in which the members are located. We tried to do this for all the initiatives that we analyzed, to also to define some kind of overlap. But this was a very difficult exercise. It showed, because different databases show different names, and also sometimes it's a headquarter and sometimes it's daughter companies, and headquarters also have different branches in different locations. So this is a puzzle that we need to solve the next year or so. And also this Divest Invest initiative is not only targeting financial institutions, but more than 1,000 are non-financial institutions. And then I don't know exactly why, but especially in Australia, there are a lot of pension funds that commit to divest to coal or fossil fuels, and well, because of these pension funds that in Australia, that's why this number is now so big. But so yes, this is in the end, I guess, a data artifact which we will need to solve the next year or so.
Thanks, Mark. Anything to add, Katharina?
No, I think Mark already summarized it. That doesn't really mean that there's nothing happening, that there are no investors being active in other parts of the world. It's just maybe they have not been reporting on this. So yeah, I think it's just doesn't necessarily mean there's no action in other parts of the world, may just not be captured.
Yeah, that's what I would assume as well. No, that we don't know that it's happening doesn't mean that it is not happening. So a bit more research is necessary, I think, especially in the global south. I'm not sure whether that's the case for financial institutions, but I assume so, yes. Thanks for that. Then we have another question here, and by the way, don't be shy and use the questions. We still have room for more. There's one question, or perhaps more a comment from Edgar van den Burg, saying that Tom mentioned, or in several speakers actually mentioned, that there's a lack of methodologies for investors to do what they need to do, to invest in a Paris compatible way, to quantify the impact of their investments. So there's a huge need for new methodologies. And maybe I think what would be useful for the audience as well, if we could do a quick round of the different methodologies that people know are available that can be used for this, because there's many around, and well, it's a whole field of experimenting right now on how to do this. We mentioned already a few, but I think it would be nice to have a rundown of which methods are available. And here in the question, Edgar Vandenbroek was mentioning the PCAF initiative, the Carbon Accounting Financials, which is a method to where financial investors can quantify the carbon footprint of their portfolio. This, I think, a super interesting tool, but I'm sure there are other ones. So maybe if anybody wants to take that question on additional tools there for investors to do that. Emily is raising her hand. Go ahead, please.
Sure. So I think from CDP's perspective, the PCAF, the Partnership Carbon Accounting for Financials, is one of the strongest Scope 3 carbon accounting methodologies that we've seen. They've recently been doing a public consultation, and I'd encourage people to certainly look through the methodology that they've put out. I think Jess may have mentioned this as well, but there is also the Science-Based Targets Initiative is coming out with their financial institutions methodology for setting science-based targets. Now, I think a number of these are complementary rather than conflicting, and this is still a growing area. I think given the sort of nebulous nature of the information that people are looking to quantify, our advice is to look at the methodologies. Don't try to choose one over the other based on their merits, but to start somewhere. And I think a number of the both NGOs as well as other data companies have started to develop tools to be able to enact these methodologies.
Anybody
I'd
to
also
add?
be happy
Jessica?
to come in there.
Go ahead, Jessica. Sorry.
Yeah, sure. I should have also recognized PCAF's good work, and I think it informs some of the approaches under SBT as well. And there's a lot of connection points between all of these initiatives we've been naming. The other, of course, is the temperature alignment methodology, and there's been a lot of work, around that recently. So I think we're seeing a really growing field of approaches on this. I think the more challenging bit is different asset classes, and how for some of those which are more which are less concrete, it can be a bit more challenging. So I think that's where we'll have to see a lot more innovation to ensure that financial institutions can really cover their full portfolio.
Excellent. Then anybody else to add? Have we covered most of them? I think so. Yes. Okay, then let's move to another question, and that is in the financial sector, or the first presentation we had on the investment targets, we had 3 different types of mechanisms how financial institutions can move real-world emissions. One was divesting, one was engagement, and one was positive impact investment. And the question would be, how would you see those mechanisms evolving? And is there, would you see that one is superior to the other? Do we need all of them? What would you say about that? Anybody interested in taking that question on mechanisms how financial investors move real-world emissions? Emily was first.
Sure. So I think, from our perspective, we think all different types of initiatives are important. Ultimately, from CDP's perspective, we are working through our capital markets program to change the cost of capital. And I think that's really where the financial sector across financial institutions, investors, credit rating agencies, stock exchanges, financial regulators, all have the opportunity, and this works across a number of different products, is that if we start changing the cost of capital, and that I think that stretches across all 3, then we really have a component. I would we're certainly very supportive of Divest, Invest, and their movement. But one of the things that we hear from a lot of our universal asset owners or universal holders is that they say, even if I divest, I don't necessarily know that stewardship is going to go to an investor who will actually do that engagement. So that may not long term help with the long term emissions.
And if I may turn to you directly, Jessica, is that a similar view you have at the Net Zero Asset Owner Alliance?
Yeah, I think the report that Katarina and Mark and others did was really wonderful assessment of the different levers that asset owners or investors more broadly can have. I think what was really interesting was to see some of our theory of change or some of our assumptions, you know, bore out in your data sets in terms of, you know, what is likely to have influence and not, or less likely, I should say. And just to echo Emily's remarks that, you know, there is, you know, arguments to be made for adjustments to cost of capital, but we really believe, as I mentioned at the start of the presentation, that it is concerted action across all the asset owners, hopefully a growing number of them with, you know, a growing number of influence via their AUM and their collective engagement strategies that will hopefully drive change. We really see engagement as, you know, the most effective lever that they can pull, but there are many levers, and hopefully you start to employ them in a more holistic approach, and that will get us some progress. So thank you.
Excellent. No, I think we see that we have a whole toolbox of things that we can do, and I think we need to use them all since time is short, and learn as we go. Another question is exactly on that learn as we go. We now see more and more commitments coming, so more and more actors are committing to do something. That's the first step. Second step is then also to do it. And are we, there's a question here on what are we seeing to, whether these commitments are really realized and create an impact. What can we do that it's not only words out there, but that it is really implemented and to have real impact? Is there anybody who wants to take that question? Tom.
Thanks, Nicholas. Yeah, I think there are a number of reasons why companies, financial institutions, would want to set such targets and to decarbonize. But I also have the impression that a lot of the target setting that we're seeing is driven by a rapid increase in public engagement and awareness in this topic, especially when we see that it's really consumer-facing sectors that are leading the trend in this target setting. And if this is what's driving it, then I think something which can make it, which can increase the chances of successful implementation is if we focus on increasing the quality of those targets. So if it's consumers that are driving the targets in the first place, then we need to, in my view, help the general public to further understand the nuances of what these targets mean, so they can continue to apply the successful pressure they're applying in the right directions, and so that it won't be possible anymore for companies to make easy communication strategies, but they will really be forced to talk about the details and to get serious about the details. And if this is something that that consumers keep pushing the way they have been, then I think we can see some real action.
Yeah, Mark, to add on it?
Yes, thanks. Yeah, as a scientist, I would say data, 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 of course. And but to get this data, I think we first need to solve that a lot of this data is very sensitive in terms of competition. So we need to find a way, bring together governments, companies, to find out what types of data can be brought together on a mutual platform. And I think we should even go out of the box, like maybe we need blockchain or other types of artificial intelligence techniques that at least the data is verified with a lot of trust, and then only a certain level will be reported to the outside world.
Yeah, thanks for that. And that's a call for transparency, and only with transparency you can keep up the pressure that things are really happening. But you are mentioning, Mark, that some of the data, especially in the finance sector, is sensitive. And it's related to competition and things like that. So what can we do to make this data available in some kind of a form? For example, for this report, we were trying to find assets under management to aggregate all of that, and already that was a difficult thing to do. So what can we do to get that data out there, even if we have difficult situations with the financial sector where some of that data is sensitive. Does anybody have a good idea on what to do that? Or, I don't know, CDP, Emily, you are working a lot with that data, and you will probably have that question, or you, Jessica, on working with the financial institutions. Do you have a way out? Emily?
I don't know that I have a way out per se, but I can certainly talk through some of our approaches, because currently through our questionnaire, and this year we piloted our financial services questionnaire for the first year. So again, trying to get a handle on looking through that scope 3 and getting banks in particular, but banks and insurance companies, asset managers to start getting comfortable with how they report on this. And one of the things that we have found is that a lot of these financial institutions have done good work in the background, but are not ready or comfortable to share that for, I think, a couple of reasons. One is certainly business sensitivity, but the other is that they don't want to look bad in comparison to their other counterparties. Now, in terms of a remedy for this, I think that one is around the role of financial regulators, and we've already seen financial regulators in different markets sort of step up and say, this is the type of information that we are going to require from you. We've seen the Bank of England with their stress test going to financial institutions and asking for this information. I think it will be several iterations before we get it right. But it is, as we've discovered over 20 years, a process of trying to A, extract the information, but B, get people comfortable with that level of transparency.
Excellent. Anybody else to add on this one? No, because I think that's interesting, because another question that was coming is, what can governments do to help this whole process? And you already answered it, Emily, with regulation for the financial sector, that I think would already help quite a lot to move the financial sector to have to disclose certain data points. So that's useful. I think we can already now slowly wrap up. I said at the beginning that I wanted to give all of you still a opportunity to say some words at the end, so to say. Each of the panelists, if you have something to add or your takeaways from the session. I would basically start from the list that I see here. I don't know what order that is, but anyway, there, Katarina, you are the first one. So any closing remarks from you?
Yeah, so no, I think it's very promising or encouraging to see the level of ambition that we see from the financial institutions, but will be key that where we make progress on those targets. And I am really interested in seeing how this will play out for some of these net zero targets in particular. Yeah.
Thanks, Katarina. Mark?
Yeah, thanks. Yeah, 2 short remarks. Yeah, as I already said, I think transparency is key. So I think that's one of the takeaways, that there's a lot of things going on, but we need to have a good overview of what this really is meaning. And then second, also, I think a lot of things have to play out in climate change. We have not decided what technologies to use. Is it hydrogen or electricity? But on the other hand, a lot of governments are already making plans for 2030. So at least I think, especially financial institutions should not wait to get the whole picture first, but they can already work together with governments and see what the first steps which first steps are needed in this.
Thank you, Mark. Tom?
Thanks, Nicholas. I also see that it's very encouraging that there's increased ambition. On the other hand, I think it remains to be seen whether what we're currently seeing is ambition or communication. And until we see that, I think we need to strike a balance as observers of praising, celebrating, rewarding, but also being very critical and asking for the details. And I think in particular, as much as we praise those who put forward these targets, we should also celebrate the companies that are offering more detailed transparency on exactly what they're doing in order to show that as best practice, even if the target level they're communicating isn't as high as we see from others sometimes.
So word of caution from Tom. Thanks for that. Jessica?
Sure, yeah, and I'm happy to follow Tom's remarks there because I think that they're important ones. I want to echo the thoughts around transparency. I also want to just reinforce the idea of reliable scientific models. I think making these commitments that are 3 decades out is pretty challenging, and the ability to set intermediate targets on how to get there really relies upon having really good information from an investor's perspective on how some of these things might play out, and being able to understand technology developments and apply those to the different businesses you own is a really complex process. And so then, of course, it's difficult to set targets on that. But I think we're seeing a lot of ambition, we're seeing a lot of growth, and we're really starting to get better at what we want to be reporting on. It's just we need to get better much faster, and we need to be really transparent and critical about that. So thank you for having me. It was a pleasure, and I think I'll leave it there.
Thanks, Jessica, and over to you, Emily.
Great. Well, first of all, we are delighted to be feeding data into CAMDA and the Global Climate Action Portal. We think it's important to have the data available for people to be able to use and analyze and take this independent view. To the companies that are working and the issuers who are working so hard to put information together, as well as now the financial institutions, our advice is don't get hung up on the paralysis of the methodologies and the process, et cetera. Start somewhere. And I would echo both Tom and Jess's responses in terms of let's celebrate the work that people have done and continue to push them harder. I think as independent observers and practitioners, we must look at both sides, because otherwise we risk having people feel defeated and giving up on a really critical component of the transformation that the world needs.
Excellent, thanks. Yeah, and with that, we already come to the end of this session. And yeah, for me, it was very interesting and super exciting to see the new work coming out and see your responses to the questions here as well. I see we have a lot of momentum going on, but at the same time need to be a bit cautious to see whether that really also materializes in real action. But I think the main thing is, well, we need to go ahead because time is short. Yeah, I thank all the speakers. Thanks for your great contributions. Thank you all participants for participating, listening to us, asking your questions. And if you have further questions, reach out to us, and don't forget to download the reports, and we'll stay in contact. Thank you very much. Bye-bye.